Friction can slow down any machine. If you've ever ridden an exercise bike, you know that you can turn the knob in the middle to increase pressure on the flywheel, which causes that wheel to slow down. It's harder to pedal, harder to make that thing operate smoothly. Seems like we've had a little friction on the flywheel of the US economy and US markets recently. And the question is, what's going to relieve the pressure and bring things back to smooth operation? My name is Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our financial perspectives, where we take a look at the kind of behavior of markets and economies over the last week or two and try to decide what's really important to pay attention to. If we look at markets over the last year, markets really look very positive. The broad US bond market and emerging markets are in negative territory since January 1st, but otherwise equity markets around the world have really been operating fairly well. And you can see that in that upwards trend, particularly at the beginning of the year. But here recently, since June 30th, some frictions have surfaced, causing markets to slow down a little bit. Virtually all broad equity markets ended the third quarter in negative territory. You can see a slight uptick in the first week in October. Part of that's because Congress reached a deal on the debt ceiling, but you can just see there were some frictions in that third quarter that seem to be slowing things down, making the economy or market kind of work harder. So what's happening? Well, one friction that's appeared and continues is certainly has to do with global supply chains. You can see these things just if you drive by a car dealer lot. They're empty. There are now estimated only 17 days of inventory for car sales on car lots across the country. There's an average of 64 days of inventory from the years 2015 to 2019. The number of vehicles not being produced, as this graphic shows, is just getting bigger and bigger. Those circles represent vehicles that would otherwise have been produced, but the chip shortage or other shortages are causing them to get kind of laid by the side, waiting to be produced and shipped to dealers to ultimately restock those lots. The global supply chain for goods and services is still struggling to come back online fully, whether it's chips for cars and computers or raw materials for construction, natural gas for power and heating, plus just the shipping capacity to move things. If you go to any major port around the world, you'll see huge container ships sitting out in the water waiting to get into dock to be unloaded. Problem is there's not enough labor to unload them, nor is there enough truck drivers and transportation to get those products moving across the country. The friction of COVID-19 continues, though it seems to be lessening recently. Hospitalization and infection rates, which had climbed precipitously at the end of the summer months with the Delta variant, have begun to decline a little bit, starting to look more like the numbers in May, when things seem to be more under control. The 1 week average of new cases has dropped 40% since its September 21st peak. Finding qualified workers and getting them hired is another friction. The US added only 194,000 jobs to payrolls in September, down from 366,000 in August. Some analysts had been predicting a gain of 500,000 new jobs. There are plenty of job openings, but finding people to fill them has been a real challenge for American business. The unemployment rate actually fell 4.8% or to 4.8%, down from 5.2%, as some workers actually exited the labor force, or they just stopped looking for work, removing them from those numbers, the labor participation number. The participation rate, those members of the population looking for work or working, fell to 61.6% from 63.3% in February 2020. This lower participation rate just reflects a hesitancy for some workers to return to work, whether it's due to COVID's Delta strain, delayed school reopenings, or payments maybe supporting the unemployment opportunity. There's all kinds of things at work just causing it harder and harder to find workers to go back to work. And those businesses that are hiring, you can see in the chart on the right, are having to pay more and more to get those workers to come back, leading to some wage inflation. And that's another friction, really, inflation. Wage inflation is not the only inflationary one. Consumer prices have been inching and recently jumping higher as we put the contracting environment of mid-2020 behind us and consumers are ready to spend more on goods, services, and travel. That wage inflation on the previous side, the supply chain squeeze, now we look at the price of energy, service, goods, food. They're all creating inflation above 3%, upwards of 5.3% if you look at the chart on the left. That's the first time inflation has been above 3% since 2012. Not only is actual inflation a friction, but the uncertainty around how long this inflation will last or how high it will go, that's certainly bringing about friction in terms of slowing down the economy and markets as well. When is the political environment ever not a friction? I'm not sure, but it certainly is a friction right now. The Senate once again walked right up to the edge of the debt limit and default last week, but because the US debt is growing and the dollar amount the US Treasury can borrow is limited by Congress, periodically this limit must be increased in order for the US government to make interest and principal payments on US Treasury bonds and to keep the government open. The compromise voted on last Thursday raised the debt limit by $480 billion, which is estimated to keep the lights on in terms of government service and debt service until maybe mid-December at the latest. This is not the first time the parties have engaged in this kind of political brinksmanship, but in this very polarized environment, the probability of an actual default on US government debt or missed interest payments, while still very remote, just begins to seem more possible. The cost of missing those payments would most likely increase the interest rates demanded by investors, and in the negative cycle, those rising interest rates would then cause our debt to become more and more expensive. That would cause even more and more friction to the economy and to financial markets. The impact of these kind of frictions is readily apparent in market activity from day to day. Last Thursday, when it became apparent that the debt ceiling compromise would happen that day, to have the friction removed, markets immediately rose between 1% and 2%. Remember that volatility just was the result of a temporary package that only gets the government funded through December. Markets and investors are constantly pricing in news, especially in this short-term news cycle that we live in today. I mentioned the uncertainty related to inflation. Friction related to legislative uncertainty is very high as well. The American Families Plan tax bill draft was submitted by the House Ways and Means Committee on September 13th, and that date turns out to be very important. The contents of this bill and how it will raise taxes and who will pay those taxes has been a subject of really intense debate. On a recent webcast sponsored by the Committee for a Responsible Federal Budget, panelists estimated that the bill, as proposed, would raise about $2.3 trillion in new revenue, while at the same time providing $1.3 trillion in revenue reductions and credits for about a net $1 trillion of net new tax revenue over 10 years. This new revenue comes from tax increases and a variety of other changes. Ordinary income tax rates get a higher top marginal bracket at 39.6%. And this wasn't surprising. Neither was a rise in the corporate tax rate, rising from 20% to somewhere around 28%. On the capital gains tax rate increases, the bill as written states that this would be effective for all capital gains sales after the draft date of September 13th. And that's important because it means that this law would take effect in terms of sales of capital assets that would have been sold in 2021 prior to the bill's enactment. That's caused a lot of people to kind of raise their eyebrows because you don't see this kind of retroactivity drafted into public policy very often. On the estate tax side, the amount of assets passing from one generation to the next without tax liability is cut in half. However, there are some special valuation provisions related to real property held by family farms and businesses to create higher exemptions for those types of people, with up to another $11.7 million of exemption in certain cases. We'll see which one of these things actually survive through final passage. Some things that were not in the current bill were surprising. State and local tax or SALT deductions were not in the original bill or the bill that there's currently discussing. Also, the idea of the step up in basis at death, so for an asset that has lots of appreciation built into it during a person's lifetime, if they die and pass that asset to the next generation, all those built up capital gains are kind of dismissed, and the basis for tax purposes of the asset is stepped up based on the value of the asset on the date of death. That's been kind of the subject of a lot of controversy and a lot of debate, but right now that step up in basis as it currently exists in estate tax law still exists in the new bill. Most DC watchers expect the increase in marginal rates, capital gains taxes, and corporate tax rates to be in the final tax bill. The retroactivity of those capital gains rates may be less certain, but it's still quite possible. For all these to pass and get to the president's desk prior to year end, well, it's largely going to depend on the Democrats in the House and a couple key Democrats in the Senate. The House progressives and the House moderates are having a debate right now as to how big that spending plan will be. That's the Build Back Better Act. It's got a price tag of about $3.5 trillion, though it's estimated to be maybe a little bit higher than that, depending on how you calculate the ultimate cost. Progressives want to spend that amount and more. Moderates would like to scale that back. In the Senate, Senators Manchin and Sinema have said they won't vote for a bill that's $3.5 trillion. Both Democrats, what's important there is in a very split Senate, 50 Republicans, 50 Democrats, and the Vice President Harris. The Democrats need all 50 senators plus the vice president to pass whatever bill comes through using what's called reconciliation, whereby they go away from usual Senate order, which requires a 60% vote, a supermajority, and instead rolls back to a regular majority, which is 50 votes. Well, if you only have 50 Republicans and 50 Democrats, the vice president becomes the tiebreaker. And in a reconciliation bill, which is how they're structuring this one, that simple majority would prevail and the bill would pass. Needless to say, there's a lot of debate between the House and the Senate and a lot of posturing in public in terms of what will survive into the final bill and what will become passable, because it looks like they're going to get no cooperation from Republicans. So the Democrats are trying to figure the size of both bills to get it across the finish line and to the president's desk. Once they get it into the Senate and the Senate votes, if the bill's not amended, it'll immediately go to the president's desk for signature. If the Senate amends the House bill in some way, there'll be a conference committee consisting of both select senators and select House of Representatives people. They'll get together, try to draft a compromise. If the amendments are not too large or can be compromised, they may or may not have to send the bills back in identical form to each chamber for passage before ultimately that bill would get to the president's desk. I know it sounds confusing. As a former legislator, all I can say is stay tuned. There's a lot of work to be done within the Democrat Party, both in the Senate and the House, to get a bill towards final passage. We shall see. Completely different subject here. Foster Group is hosting a special event in the next couple of weeks. Morgan Housel is an author who we enjoy quite a bit. He's written a book called The Psychology of Money. We read a lot of the things that he writes online as well. Morgan will be in Des Moines giving a live presentation to our audience there. We'll also be having watch parties in Omaha. That is going to be October 21st. We'd love to have any of you who are interested in attending sign up with us and be there. You can find registration information on the Foster Group website, and you can see it here on this slide as well. As always, if you have any questions or would like to meet with a Foster Group advisor, please contact us. Our team is fully engaged every day. We're happy to meet in person or using technology, whatever is your preference. If you want to have a conversation about your portfolio, your financial plan, or how some of these things going on in terms of frictions in the economy might be affecting either one, give us a call and let's get together and have a conversation. Also, if you have any other questions, some of the things that we talked about today were in response to questions that we've received. We love to do that. So let us know what your questions are, and hopefully we'll be able to address them in future editions of Financial Perspectives. Thanks for tuning in today. We hope to see you soon.